Hello, welcome listeners and market participants. Thank you for joining KBRA's European Credit Podcast, Conversations in European Credit. I am Gordon Kerr, Head of European Research at KBRA, and today I'm joined by a number of my colleagues from the European Ratings team here at KBRA. Welcome Killian Walsh from our ABS team.
Hello, Gordon. How are you doing? Great to be here.
And Carl Cubbins, also from our ABS team.
Hi, Gordon.
And Gabriele Gramazio from our Structured Credit team.
Hi, Gordon, and hi, everyone.
Today, we will be covering the second half of our expectations for 2024 in European securitization markets. Will 2024 bring us an economic soft landing or a hard one? Will interest rates remain high, or will an economic slowdown cause central banks to begin cutting rates? Many key elements are improving each day, with inflation rates slowing and unemployment remaining low, but many other signals suggest a slowdown ahead. Next year looks to be a bumpy ride as central bankers and governments navigate the coming turbulence. For European securitization markets, continued collateral performance deterioration is likely in 2024 as borrowers in some sectors begin to feel the impact of current conditions. On the other side, the funding environment has changed to bolster securitization issuance, with the European Central Bank and Bank of England stepping back from bank funding support. In this second of two podcasts covering the outlook for European securitization markets, we will be focusing on the issuance prospects for European securitization markets, as well as asset-backed securities collateral and structured credit markets. On the supply side, new issuance is expected to increase as lenders look to the capital markets for funding purposes again. Banks are returning to an environment where they will be more dependent on capital market funding in comparison to prior years. With central banks withdrawing low-cost funding options, bank issuers are expected to return to the capital markets. However, this will not completely eliminate the retained transaction market, as banks will either continue to retain transactions and make use of them in bilateral, non-central bank refinancing operations, retain them for future liquidity needs, or hold on to them and sell part or all of them into the capital markets when best suits, as done recently by Nationwide. This approach is often referred to as a stock and drop, when issuers stock up with the retained transactions and then drop it into the capital markets when the timing suits. For the coming year, there is a strong concern that collateral performance deterioration will deter investors from the sector. However, there have been increased allocations to fixed income funds that rates offer a more attractive return profile. This will help support demand for structured finance transactions. However, an increasing proportion is going into the private sector, so will probably be allocated more towards synthetic securitizations or other private debt opportunities in the structured finance space. Still, nonetheless, the environment has improved for investor interest in the securitization markets in Europe. The use of synthetic risk transfer securitizations is expected to remain strong in 2023 as bank issuers look to increase capital buffers ahead of incoming Basel regulation changes. As we highlighted in our Capital Relief Trade Seminar conference recap, the growth of this sector could spur increased rated transactions in what is largely an unrated transaction market. The use of this market by banks is not a direct alternative to the cash securitization market, but it does commit collateral that may otherwise find its way into the public European securitization markets. Overall, KBRA expects that the European securitization market issuance will increase in 2024 to reach levels similar to 2019. We expect that the first time since 2019, and only the second time since the global financial crisis, newly circulated transactions will outpace retained transactions. In total, we expect approximately 240 billion in total issuance, with about 115 billion in newly circulated transactions and 100 billion retained. Potentially improved financing conditions could spur a return of resets and refinancings in the European CLO market as well. Now, enough of the issuance prospects for the market, and turning now into the collateral side of things, I am joined by my colleague Carl. Carl, how do you see the impact of the current high rate environment really developing for consumer collateral?
Thanks, Gordon. We expect a moderate decline in collateral performance of transactions backed by consumer collateral, with delinquencies expected to increase. As you mentioned, after a prolonged period of a very low interest rate environment and moderate inflation in prior years, we see the impact of the increased interest rate environment and inflationary impacts over the past 2 years, resulting in increased stress on collateral pools within the consumer segments. Observed impact from the higher interest rate environment has been muted to date in many ABS transactions, as rate rises have historically had a delayed impact. Consumers generally use savings and unused lines of credit to balance their household budgets. These savings are expected to continue depleting as the higher interest rates and inflation impacts bite. In addition, governmental supports, for example, on the price of heating and energy, will likely abate in 2024. Consumers with floating rate obligations, particularly in relation to mortgage debt, are likely to feel greater stress as a greater percentage of their income and savings are going to service these debts. Consumers are also likely to prioritize making repayments on secured collateral ahead of unsecured collateral. Employment is likely to be an important variable on the performance of consumer ABS collateral performance over 2024. Unemployment levels have remained at low levels and labour markets remain relatively tight, which positively impacts consumer performance. The extent of an uptick in unemployment through 2024 will be felt across consumer transactions. That being said, although a number of corporate layoff programs have been announced across different sectors in Europe, labour markets are holding up relatively well. We therefore expect collateral performance to weaken marginally, with increased delinquencies with more meaningful deterioration if the employment outlook deteriorates. In relation to the unsecured consumer credit market, we have seen some uptick in delinquency and loss rates, albeit from low levels, and expect continued deterioration in performance towards pre-pandemic levels and possibly in excess of those levels. This is likely attributable to the impact of cost of living increases, higher loan balances, and higher interest rates.
Now, what about in the auto world? That is a large part and has been a growing part of the European securitization markets. We've commented on the past on residual values for vehicles. How do you see this developing in 2024?
So used car prices have increased significantly due to pandemic-related supply and demand dynamics. This had in the past helped recovery values on defaulted receivables, positively impacting performance, and incentivized borrowers to make timely payments at higher replacement costs incentivize against defaulting. Residual value components are also securitized in a number of auto ABS transactions, and performance had been strong to date. Used car prices generally remain higher than their pre-pandemic levels, but have declined from their highs. There has been a steeper decline in the values of battery electric vehicles due to a number of factors. This has been impacted by historically lower volumes and limited choices within electric vehicles, but most notably significant pricing competition from OEMs to capture market share, with price cuts on new vehicles and new entrants as OEMs have invested significantly into their production lines for electric vehicles. The price of a new vehicle is a significant driver of the value of used vehicles when the differential between the price of new and used vehicles reduces. In general, however, we would expect dynamics of the used car market to revert to historical trends and cause automobile credit performance to soften in 2024 as the automotive supply chain returns to its historical efficiency and demand for new vehicles cools. Higher financing costs and a slower labour market impact this as well. The electric vehicle market could see a stabilisation as the market matures, which could also be helped by improved infrastructure and consumers getting more comfortable with the specific logistics around insurance, repairs, home charging, etc.
Thank you very much for that, Carl. Now, the asset-backed world is not just all about autos and consumer loans. KBRA has also been active in a number of commercial-oriented sectors in the ABS world. Killian, how do you see the challenges facing this segment of the market?
Thanks, Gordon. I suppose it's looking forward, it's a challenging year potentially ahead for this. Commercial ABS credit fundamentals will remain under pressure in 2024 as the economic environment remains challenged, coupled with ongoing higher interest rates and low consumer and business confidence, which is expected to continue into 2024. The commercial ABS sector does encompass a large and diverse range of asset types, and some commercial sectors and collateral types will be affected more than others. Looking at small and medium-sized enterprises, they're presented with a challenging environment entering 2024, primarily due to increased borrowing costs, reduced consumer and commercial spending, and increased default risk. Corporate bankruptcies in both Europe and the UK continued to increase during 2023, with Q1 to Q3 2023 bankruptcies approaching the highest levels in a decade, a trend that we at KBRA expect will persist during 2024. Businesses in sectors exposed to discretionary spending, specifically high-end luxury along with leisure and travel, may also experience a more challenging business environment. Bank finance tends to become less readily available for many SME entities during recessionary periods. As a result, they are expected to struggle with needed funding. However, private lending has grown in volume, and this additional funding available from bank alternatives may help to support this segment of the economy. Further, this may lead to ultimately greater activity in the securitization market for these types of lending platforms, such as SME, as these non-bank lenders look for alternate sources of funding in 2024.
Thanks, Killian. Another sector that KBRA has been very active in, US side of the business, is the solar market. Will 2024 be the year that we finally see some public transactions here in Europe?
It's a very good question, Gordon. It's something we're often asked. And I think the very simple answer is yes. Into 2024, we at KBRA ran our second solar symposium in Frankfurt just gone in November. And there was a lot of interesting views from issuers, arrangers, market participants in general. I think what you're now seeing is entities growing to a scale that enables securitization to be a viable potential during 2024. The markets we're seeing activity in is particularly in Germany, but also in the UK and Spain. I think what we're seeing is a similar position to where the US was in 2015, 2016. And we've seen the growth in that market grow exponentially over that period of time. To date, KBRA has rated well over 100 transactions in that market. And hopefully we will see similar activity in a European space over the next number of years. But in very short, yes, we do expect to see some public market activity during 2024 in this market.
Thank you very much for that, Killian. Hopefully the solar market does start to develop here in Europe. Now, turning our attention over to the collateralized loan market, Gabriele, 2024 is likely to be a challenging year, as Killian highlighted, in the commercial space. How do you see the loan market developing in 2024?
Thanks, Gordon. The structured credit market faces a challenging road ahead, as you say, in what is expected to be a difficult, possibly financing environment in 2024. Loan originators and portfolio managers will continue to consider balance sheet cash, capacity under revolvers, and the ability to raise new capital in their assessments of corporate borrowers with higher financing costs. The drastic shift in rates has also caused corporate valuation to taper off, increasing lender and sponsor focus on their portfolio companies' cash flows and cost structures. For example, direct lenders have stressed the importance of iterative underwriting to continuously evaluate the sufficiency of borrower liquidity and the length of their cash burn runway. During this period of elevated rates and economic uncertainty, private credit has somehow helped stabilize the liquid loan market, as Killian mentioned actually previously. Certainty of execution, fewer counterparties, and more controllable outcomes have attracted capital and should continue to bring more deal flow to the private credit space. And by the way, this could prove to be a driving force behind the establishment of a private credit and middle market CLO formation in Europe. So something to watch out for this 2024. In terms of CLO credit performance, a high proportion of single B rated levered companies will have to refinance their debts in 2025 and 2026. At rates and condition that may prove to be challenging, especially if rates remain higher for longer. We do expect this factor to contribute to an increase of defaults in 2024. So European CLOs had loan balancing defaults totaling nearly euro 1 billion as of the end of November 2023, which is a dramatic increase over 2022, but this remains a small percentage of the sector's outstanding amount of euro 230 billion. In addition to that, in the second half of 2024, some of the most highly leveraged companies with weak capital structure approaching their refinancing dates can trigger an uptick in CCC exposure in CLO transactions. Should meaningful credit deterioration occur, non-investment grade structured credit ratings from seasoned deals will remain sensitive to rating migration.
Great, thank you. Now, what are your views with regards to the development of the issuance market in 2024?
So, given all the headwinds we have just mentioned, our issuance forecast is cautious. So, in 2024, for Europe, we forecast something in the area between euro 20 billion and 25 billion, which is generally in line with the previous 5-year annual average. Broadly syndicated CLO volumes, so will likely be held back by continuous lack of arbitrage in deal structure that will limit the ability of managers relying on third-party equity to raise new vehicles, but also a continuous soft M&A market activity due to high rates and economic headwinds. On the bright side, the investor market remains bullish on the asset class, given the strong track record that the product has displayed over the past 20 years. From a return perspective, leveraged loans and CLOs are among the best performing asset class year to date. Additionally, with more than 30% of outstanding European CLOs outside of their investment period by year end, bank investors will likely return to the market to replenish their senior note holdings, and this, in turn, could support spread tightening at the top of the capital structure, increasing the arbitrage opportunities and boosting new deal volume.
Thank you very much, all of you. As you have heard, the market appears to be in a transition, both in terms of collateral performance as well as new issuance. With rates high and likely to remain so in the near term, borrowers will continue to be squeezed at the start of the year, challenging performance in sectors such as credit cards and consumer loans, as well as businesses struggling with refinancing and cost inflation. In particular, markets with high leverage will continue to see weakening performance. On the positive side, low unemployment levels, strong underwriting quality, and skilled servicing should help to keep performance from deteriorating greatly. You can find greater detail in the recently published report on our website. We hope you managed to listen to our previous podcast, where you will have heard more on the RMBS and CMBS markets. If not, go back and take a listen. Make sure you are registered to receive our latest commentaries and have subscribed to our podcasts, and be sure to give us a review. Of course, please reach out and engage with our experienced analysts. Thank you very much for listening. We look forward to bringing you more conversations in European credit. We hope all of you have had a great holidays as we prepare for what is shaping up to be a turbulent year ahead.